Hello students, welcome to the lecture. After this lecture, you will be able to develop a clear understanding of the major categories of banking risk and their sources. To explain how risks are measured, managed and mitigated within a structured governance framework. To highlight the interlinkages among the different risks and their impact on the bank stability performance. Now we will start with the introductory part. So risk represent the unavoidable possibility of loss inherent in all the banking activities. Banks mobilize deposits, extend the loans, participate in financial markets, operate payment systems, and manage the sophisticated technological infrastructure. Each of these functioning generates exposures whose outcomes cannot be predicted with certainty. Risk management in banking therefore refers to the systematic process of identifying these exposures, measuring their potential impact and making the informed decisions through policies, capital allocation, internal controls and hedging the strategies. To limit the likelihood or magnitude of the losses to acceptable levels. Effective risk management goes beyond the regulatory compliance. It lies at the heart of the strategic decision making. And the product pricing, capital deployment, as well as the maintenance of public trust is also there. A bank that inadequately measures the risk or responses slowly to changes in its risk profile may suffer losses, and that spread across its balance sheet and undermine its reputation and the long-term franchisee value. Now we will move towards the next slide. So the credit risk. It refers to the possibility that a borrower or counterparty will fail to meet the contractual obligations, resulting in the financial loss to the bank. And this form of risk arises in conventional lending, trade financing, and off-balance sheet exposures such as the guarantees and letter of credit, as well as the investment activities. The assessment of credit risk, it begins with an evaluation of the borrower's character, repayment capacity, and the capital strength as well as the collaterals. Commonly captured in the traditional, we can say the 7 C's framework and extended to more formal tools such as credit scoring models, financial statement analysis and sector level stress testing. Now we have the initial appraisal. So beyond the initial appraisals, the credit risk is managed through the conservative underwriting standards, well-designed covenants and adequate collateral exposure, concentration limits. It phased the provisioning for expected losses as well as the continuous monitoring of borrower performances. Banks also incorporate the credit risk into pricing by reflecting default probabilities, recovering the rates where risk remain excessive despite the mitigation, exposure limits or outright the rejection become necessary. Now let's move to the another slide. So the market risk we have now. The market risk, it encompasses, we can say, the potential losses arising from the adverse movements in the market variable such as the interest rates, foreign exchange rates, equity prices, then we have the commodity prices or we have the credit spread. Unlike the credit risk, market risk is often driven by the macroeconomic developments and the short-term liquidity conditions, necessitating the analytical models that captures the volatility, correlation and scenario dynamics. Widely used measurement techniques including the duration and the convexity analysis for interest rate and risk, the value at risk, that is VAR, to estimate the potential losses within a given confidence level, and the sensitivity measures, the Greeks we can say, for option portfolios are there. Since quantitative models have inherited the limitations, scenario analysis and stress testing where the portfolio are subjected to extreme yet plausible market shocks are essential complements. The market risk, it is managed through the exposure limits at various levels, hedging with the derivatives, portfolio diversification and active asset liability management to ensure that the assets and the liabilities, they respond consistently to the market changes. Now let's move to the another slide. So it is on the operational risk arises from the breakdowns in people, process, systems or firm external events. It includes the losses resulting from the fraud, human error, process failures, technology disruptions and the legal or compliance breaches. With increasing digitization, the scope of operational risk has expanded to cover the cyber threats, failure of outsourced service providers, and the complex incident responses, the challenges. Because operational risk is diverse and the less amenable to precise the quantification that credit or market risk, the bank relies on a combination of tools such as we can say the internal loss databases, key risk indicators, scenario analysis, and the detailed process mapping to estimate the potential exposures. Mitigation measures include the segregation of the duties and the automated controls. Then we have the robust access management. Then we have comprehensive incident reporting and the effective business continuity and disaster recovery planning. So strong legal compliance, continuous staff training, and a culture of internal control are equally critical, as many operational losses can be avoided through the disciplined governance and procedures. Now let's move to another slide. So the liquidity risk, it is the risk that a bank will be unable to meet its financial obligations as they fall due without incurring the excessive costs or the reputational damage. Such difficulties may arise from the sudden deposit withdrawals, disruptions in funding markets, or mismatches between the maturities of the asset and the liabilities. Liquidity risk measurement relies on the cash flow forecasting, maturity mismatch analysis, and the standardized regulatory metrics such as the liquidity coverage ratio, that is LCR, and the net stable funding ratio, that is NSFR, which assess the short-term resilience and the long-term funding stability. And the mitigation strategies, this will include the maintaining adequate holdings of highly qualitative or the highly quality liquid assets, diversifying the funding sources across the retail and wholesale markets, then securing the committed credit lines. Then we can say preparing the contingency funding plans and setting the internal limits on the maturity transformation. Liquidity risk management is closely interconnected with the credit and market risk, as funding pressures often intensify when the asset quality deteriorates or the market confidence decline. Now let's move to another slide. Measurement and mitigation, they are inseparable from one another because of the effective risk management. Measurement provides the transparency through quantitative models, stress tests, rating systems, and key risk indicators, while the mitigation, they translates this insight into concrete actions such as limits, approvals, and capital buffers. A part of that, we have hedging strategies, collateral requirements, as well as the operational safeguards also. So no single techniques is sufficient in isolation. Consequently, banks develop the integrated risk management framework that combine the preventive measures, sound underwriting, system resilience, portfolio diversification. Protective measures, that is related to the capital reserves, insurance, hedging instruments, and the detective or corrective measure, that is related to the monitoring systems. Then we have incident responses mechanism. Then we have recovery planning. So governance structures, it will include the board oversight, a clearly articulated risk appetite, independent risk management functions, and the regular independent reviews. Bind these elements together. When risk measurement is robust and mitigation is consequently applied, banks are able to take calculated risks that support the profitability while maintaining the resilience against the adverse shocks. Now we will understand about the risk management in banking. So risk is an unavoidable aspect of financial intermediation, we know. The fundamental function of a bank, mobilizing deposit and transforming those funds into loans, investments and financial services, continuously expose it to the possibility of loss. Risk management in banking is therefore not a discretionary or peripheral activity. Rather, it is the systematic discipline of anticipating, measuring, controlling, and responding to events that may undermine the capital earnings or reputation. Sound risk management safeguards solvency and depositor confidence by allowing the banks to engage in profitable business opportunities. It converts the uncertainty into a structured input for the managerial decision making instead of allowing it to become a stabilizing force. Now let's move to another slide. So we have about the risk management, that what does risk management aim to achieve? So at its core, risk management seeks to ensure that the bank operates within the risk boundaries that its capital base, liquidity position and governance framework can sustainably support. This involves recognizing the potential source of loss, assessing the magnitude of possible adverse outcomes, implementing limits and safeguards to reduce either the likelihood or the severity of loss, and continuously tracking exposure so that corrective actions can be taken at an early stage. An effective risk management function performs 4 tasks in an ongoing cycle. First one is identifying risk exposure across all banking activities, measuring or estimating these risks using the quantitative or qualitative methods. Then we have controlling them through the policies, limits and the risk mitigants, and monitoring and reporting the exposures to support the informed decision making. So risk management, they operate as a continuous feedback mechanism embedded within the both strategy and daily operations. Let's move to another slide. So why is risk management important? There are several practical and compelling reasons why effective risk management is essential for the bank. First one is protection of depositors and the savers. So banks are custodians of public funds. Poorly managed risk can result in depositor losses and undermine the confidence in the financial system. Then we have preservation of solvency and profitability. So unexpected losses weaken capital positions and restrict lending capacity, thereby reducing the future income potential. Another one is regulatory compliance. So supervisory authorities require banks to meet minimum capital and liquidity standards and to maintain the robust credit and operational controls. Weak risk practices invite regulatory intervention. Another one we have is the reputational protection. So events such as fraud, cyber breaches or operational failures can destroy the trust built over the decades. Effective risk controls help preserve this intangible but critical asset. Then we have improved managerial decision making. So when risks are identified and quantified, banks can price products appropriately, select profitable business lines and allocate the capital efficiently. Let's move to another slide. Okay, so now we have major categories of banking risk and their functioning. So first one is credit risk. Credit risk, it refers to the possibility that a borrower or counterparty will fail to meet the scheduled payments of interest or principal. It is the most fundamental risk associated with the lending activities. Credit risk encompasses not only outright the default, but also deterioration in the credit quality prior to default, payment delays, as well as the shortfalls in collateral recovery. Another one is management approach. So banks mitigate the credit risk through careful appraisal of borrowers, including the assessment of cash flows, business models, industry conditions, and borrower integrity. Loans are priced according to the risk, supported by appropriate documentation and collateral, diversified across the borrower's sector and regions, and monitored continuously after disbursement. Let's move to another slide. Now we will understand one example of the same. So suppose a bank extend a loan of 10 crore rupees to a small manufacturing firm. Internal estimate indicate a profitability of default PD of 5% and loss given default LGD of 40%. So expected loss will become principal multiplied by PD and LGD. So step 1 will contain amount and 0.5% of the amount, that is 50 lakhs. Then we have 50 lakhs. Now we will calculate the 0.4 of 50 lakhs, that is 20,000. So we can say the expected loss is therefore 20 lakhs around. So such estimate inform loan pricing, credit sizing and the provisioning decisions. Now in the another slide, let's understand about the market risk. Market risk, it arises from the adverse movements in the market variables such as the interest rate, exchange rates, equity prices and commodity prices. For example, an increase in interest rate reduces the market value of fixed rate bonds, potentially generating mark-to-market losses for trading portfolios. What is the management tool in this case? So banks employ the VAR, that is value at risk, stress testing and scenario analysis to estimate the potential losses under normal and extreme conditions. Derivatives are used for hedging and limits are imposed on position, the size, maturity and the exposure. Let's move to another slide. So now we will understand about the illustration of the VAR. So if a bond portfolio, it is worth of 50 crore rupees, has a 1-day 99% VAR of the 1%, the estimated maximum loss on 99 out of 100 days is the amount, let's suppose 5 lakh and 0.1 of that. So 0.1 will be the loss, and this estimate will help management in determining the capital allocation and trading limits. So stress testing supplements the VAR by assessing the losses under severe but the plausible scenarios. Now let's move to another slide. Now we will understand about the liquidity risk. So liquidity risk, it arises when a bank is unable to meet its payments or the collateral obligations without incurring the excessive costs. It takes two forms, that is funding liquidity risk, relating to the inability to roll over the liabilities or meet outflows, and the market liquidity risk, relating to the difficulty in selling the assets quickly without the significant price discounts. What is the importance? So banks, they transform the short-term deposit into the long-term loans, creating the maturity mismatches. Even solvent banks, they can fail if liquidity dries up suddenly. And what are the mitigation strategies for this case? So holding the liquid asset buffers, diversifying the funding sources, active asset liability management, and the maintaining contingency funding plans. Let's move to another slide. So we have operational risk. It will include the fraud and process failures. So operational risk results from the inadequate or failed internal processes, people, systems, or the external events. It includes the errors, internal and external fraud, system breakdowns, failed transactions, and legal risk. With increasing digitization, cyber threats, vendor failures, and software vulnerabilities have expanded the operational risk exposure. What are the controls? So we can segregate the duties, internal audits, access controls, staff training, incident responses mechanism, and the business continuity and disaster recovery planning is there. Let's take an example. So if software malfunction causes duplicate payments, the bank must identify the issue promptly. It will reverse the transaction and reimburse the customers, investigate the root cause, and then implement the corrective measures. So losses can include the financial cost, investigation expenses, and the reputational damage. Let's move to another slide. So we have cyber and technology risk. So cyber risk, it is related to the operational risk, has emerged as a distinct category due to its scale and technical complexity. It includes the data breaches, ransomware, denial of service attacks, and transaction manipulation. Now, what are the controls in this case? So, layered security systems, continuous monitoring through security operation centers, encryptions, access governance, vendor risk oversight, patch management, and penetration testing. Governance requires the clear accountability, often through a chief information security officer and the board level oversight. Let's move to another slide. So now we will understand about the legal, compliance, and reputational risk. Legal and compliance risk arise from the breaches of laws, regulations, contracts, or ethical standards. Reputational risk reflects the loss of public trust following such failures. These risks are interlinked, as compliance failures often trigger the reputational damage that affects the funding and business prospectus. Now, how to mitigate these? So, robust legal review, compliance monitoring, ethical codes, transparent communication, and a culture that encourages early escalation of issues. Let's move to another slide. It is on the architecture of a sound risk management framework. So, a strong risk framework is an integrated system of governance, policies, people, data, and process. Its key pillars are, first one, board and senior management ownership. So the board defines risk appetite, senior management translates it into policies and operational plans. Accountability must be clearly assigned. Second one is risk appetite and limits. So strategy is translated into measurable limits covering the concentration, capital at risk, trading exposure, and operational losses. Third one is independent risk functions. So a separate risk unit monitors and reports the exposure independently of business units. Fourth one is risk identification and measurement tools. That the credit models, expected loss estimates and VAR. Then we have stress testing and key risk indicators subject to the validation and the review. Let's move to another slide. So now we have controls and mitigations. So collateral, covenants, guarantees, hedging, insurance, and operational controls we can use. Another one we have is monitoring and reporting. So timely management information, exception reporting, and board level oversight. Another one is capital and liquidity planning. So adequate buffers beyond the regulatory minima to absorb the stress losses. Then we have business continuity and incident responses. So redundancy, alternate sites, and tested recovery plans we can use. Another one is vendor and outsourcing risk management. So due diligence, enforceable contracts, and exit rights we can use. Now let's move to another slide. That how measurement and stress testing improves the decisions. So quantitative models convert the uncertainty into actionable metrics such as PD, EAD, LGD for credit risk, VAR for market risk, scenario-based estimate for operational risk. Since models are approximation, stress testing is essential. Severe but plausible scenarios, economic downturns, interest rate shocks, or major defaults, the test resilience is required. Results guide capital planning, risk reduction, or strategic adjustments. Now let's move to another slide. It is on example of the mitigation techniques. First one is hedging. So use of forward and swaps to reduce exposure to foreign exchange or interest rate movements. Second one is collateral or covenants. So secured lending with monitoring triggers, it will enable early intervention. Third one is diversification. So spreading the exposure across the sectors and the regions, they will reduce the correlated losses. Then we have fourth one, insurance and limits. So insurance caps, they will give the exposure to the specific events, limits the restrict maximum losses. Let's move to another slide. So now we will discuss about the governance, culture, and the people. So models and systems, they cannot replace the sound judgment. Governance and culture determine whether the risks are disclosed early and controls are respected. Banks must invest in training, define the responsibilities clearly, and reward the prudent behavior over the excessive risk-taking. Whistleblower mechanisms and the leadership tone are critical. Then another one is regulatory expectations. So banks must meet the capital, liquidity, and reporting standards and pass the supervisory stress tests. Risk management serves both internal decision-making and the external compliance. Another one is crisis preparedness. So effective business continuity planning, it ensures the rapid response to disruption. Clearly define the responsibilities, backup systems, and the frequent testing determine the resilience during the crisis. Now let's move to another slide. It is on the type of risks, that is credit, market, operational, and liquidity risks. So bank, they functions as an intermediaries between the units with surplus funds and those requiring the finances. By accepting the deposits and converting them into the loans, investment, payment services, bank generate economic value. However, this transformation process inevitably exposes banks to various forms of uncertainty. When actual outcomes diverge from the expectations such as the borrower defaulting, adverse market movements, system breakdowns, or funding shortages, banks experience the financial strain or the losses. To analyze these vulnerabilities systematically, risks are commonly classified into four broad categories, that is credit risk, it is related to the danger of counterparty default. Then we have market risk, losses caused by unfavorable movements in market variable. Then we have operational risk, it is related to the losses resulting from the failure in processes, people, systems, and external events. And we have liquidity risk. So the inability to meet cash or collateral obligations with due will come under the liquidity risk. Each category originates from the different sources, manifests the differently in banking financial statements, and requires the specific measurement technique and control the mechanisms. A clear understanding of these risks is critical because they directly influence a bank's safety, profitability, and resilience. So now we will move ahead with the next slide. It is on the credit risk. So credit risk, it refers to the possibility that a borrower or counterparty will not meet the contractual commitments. Most commonly, the timely payment of interest or repayment of principals. For lending institutions, this represents the most fundamental form of risk as loans typically constitute the largest share of bank assets. So why does it matter? When loans become non-performing, banks incur direct financial losses and must create the provisions, thereby weakening their capital position. Before accounting impacts, credit losses carry broader economic consequences and reduce the future income, increase funding costs, erosion of the reputation, and in extreme cases, institutional failure. Credit risk also interact with other risks. Widespread defaults can restrict the liquidity, while failing collateral values can turn previously manageable exposures into severe losses. Now let's move to another slide. So how does credit risk arises? Credit risk emerge from the multiple factors. Economic slowdown that weaken the borrower cash flows, ineffective management, fraudulent activities, excessive concentration in a single borrower or sector, declines in collateral values or macroeconomic shocks such as commodity price crashes, regulatory shifts, or pandemics. Even borrowers initially assessed as the sound may encounter the distress if assumptions prove the incorrect or external conditions deteriorate. Now, how is it measured and assessed? So, credit valuation blends the qualitative judgment with the quantitative analysis. Key consideration include the borrower's integrity and repayment history, capacity to generate the cash flows, capital strength, collateral quality, and prevailing the economic conditions. A widely used quantitative indicator is the debt service coverage ratio, that is DSCR. Now, let's move to another slide. So, we will understand about the DSCR, how to calculate it. Net operating cash flow available for the debt services. We will divide it with the total debt services, including the interest and principal. Let's take an example. Like if a project, it generates 12 lakh rupees in annual net operating cash flow and has annual debt obligation of 10 lakh rupees, then the DSCR will become 12 lakh divided by 10 lakh. So it will become 1.20. A DSR above 1, it indicates that the cash flow are sufficient to cover the debt obligation, with higher values provide a greater margin of safety. Bank also rely on credit scoring systems and internal rating models that convert financial and qualitative inputs into estimates of probability of default. Another one is provisioning and loss recognition. So when a borrower defaults or a loan becomes impaired, banks must recognize expected losses through the provisioning, setting aside capital to absorb the potential. While provisioning rules vary across the jurisdictions and loan classifications like performing, substandard, doubtful, loss, they will come. The economic effect is universal, that the credit losses reduces the profitability and capital, necessitating the proactive risk anticipation and the reserves. Then what are the mitigation tools in this case? So first one is prudent credit appraisal, verification of borrower information, site visits and the audited financials and third-party data is there. Second one is loan structuring, so appropriate covenants, amortization aligned with the cash flows, pricing margins and the balloon payment where justified. Third one is collateral and guarantees, so use of security, third-party guarantees, insurance and credit risk transfer mechanisms are there. Fourth one is diversification and exposure limits, so controlling the concentration by borrower, group, sector and geography is there. Another one is ongoing monitoring and early warning systems, so tracking the covenant compliance, payment behavior and the market signals. Then we have collateral valuation and stress testing. Under this, reassessing the security values under stressed scenarios to estimate the uncovered losses. Let's take an illustration to understand the same. So a bank has a loan outstanding of, let's suppose, 10 lakh rupees secured by an asset value of 1,50,000 rupees. The unsecured portion is therefore 8,50,000. If regulation require full provisioning on the unsecured portion and 40% on the secured portion, it will require the provision that will become the 2,12,000 for the unsecured exposure and 60,000 for the secured exposure. Totally 2,70,000 or around 2,72,000. This illustrates that how provisioning differentiates between the secured and unsecured components. Now let's move towards the next slide. It is on the market risk. So market risk, it refers to the potential for losses arising from the movements in market prices or rates, including the interest rate, foreign exchange rate, equity risks, foreign exchange rates, equity prices, and commodity prices. Banks hold the trading portfolios, investment securities, and interest-sensitive assets and liabilities. Fluctuations in these variables directly affect their valuations. Now, what are the forms of market risk? First one is interest rate risk. Changes in rates alter the present value of fixed income instrument and affect the interest margins. Second is foreign exchange risk. So gains or losses result from the currency movement in cross-border exposures. Third one is equity price risk. So declines in stock market reduces the value of equity holding. Fourth one is commodity risk. So it is relevant where the banks finance commodity linked activities or clients that dependent on commodity prices. Now let's move towards the next slide. It is on the measurement techniques. First one is VAR, that is value at risk. So estimates the maximum expected loss over a specified time horizon at a given confidence level. Second one is duration and convexity. So assess interest rate sensitivity of bond portfolios. Third one is stress testing and scenario analysis. So it will evaluate the impact of extreme but plausible market shocks and why it matters. So adverse market movements, it can rapidly erode the capital liquidity. For example, rising interest rates reduce the market value of long-term bonds, and regulatory or accounting recognition of these losses can impair the capital adequacy. Market risk also amplifies the credit risk as falling assets, values, weaken the collateral and borrower solvency. What are the mitigation strategies in this case? So first one is hedging through the derivatives such as the swaps, future options. Second is governance controls including the position limits and the stop loss rules. Third one is duration matching and asset liability management. Fourth one is active treasury oversight of portfolio composition. Now let's take an example to understand the same. So if a bank purchases a 5-year government bond at rupees 100 yield at 6% and market yield increases to 8%. So the bond market value falls, while the exact decline depends on the duration and the principal remains. Rising yield lead to falling prices and mark-to-market losses. Let's move to another slide. So it is on the operational risk. Operational risk encompasses losses resulting from the inadequate or failed internal processes, people, systems, or external events. It includes the fraud, transaction errors, system failures, legal issues, and compliance lapses. What is the importance of this? So operational failures generate the direct financial losses, indirect remediation cost, and reputational damage. As banks' operations become the increasingly digital, the scale and complexity of operational risk have grown, making prevention and control essentials. What are the sources in this case? So first one is people, human error, insufficient training, internal misconduct. Second one is processes, so flawed procedures and weak change management. Third one is systems, so software defects, inadequate testing, cyber breaches. Fourth one is external events, so natural disasters, infrastructure failures, and third-party disruptions will be there. Fifth one we have is fraud. So internal or external manipulation of systems can be there. Let's move to another slide on the management approach. So prevention controls such as segregation of duties and access controls. Second one is detective mechanisms including the reconciliation, audits, and monitoring. corrective actions through the incident responses and recovery planning, technology safeguards like encryption and penetration testing, vendor risk oversight through the contracts and the performance monitoring. Let's take an example like a faulty system upgrade miscalculates loan interest, requiring the costly corrections and compensation. A phishing attack compromises the customer credentials, forcing rapid containment, reimbursement, and the security enhancement. Third one, quantification relies on the historical loss data, scenario analysis, key risk indicators supported by the regulatory capital requirements. Let's move to another slide. So now we will understand about the liquidity risk. Liquidity risk is the possibility that a bank cannot meet its cash or the collateral obligation when due without suffering the unacceptable losses. A bank may remain the solvent yet fail if it cannot access the liquidity promptly. Now, what are the dimensions in this case? So, first one is funding the liquidity risk, inability to roll over or the replacing funds. Second is market liquidity risk, so difficulty selling the asset quickly at the fair prices. Now we will understand the significance or importance of the same. So bank profits from the maturity transformation, funding long-term loans with the short-term deposits, but this creates the vulnerability. Sudden withdrawals or market disruptions can force the distressed asset sales at steep discounts. Let's move to another slide. So what are the key metrics with which we can calculate the same? So first one is liquidity coverage ratio, that is LCR. Here we can use the HQLA divided by the 30-day net cash outflows. Second one is net stable funding ratio, that is NSFR. So stable funding divided by the required funding over 1 year. Third one is cash flow maturity ladders. Here we will identify the timing mismatches. Then we have management tools as well. So maintain the adequate high quality liquid assets. So now we will discuss about the management tools. Maintain the adequate high quality liquid assets, diversify the funding sources, establish the contingency funding plans, conduct the liquidity stress tests, active treasury and collateral management. Okay, so let's take an example. If HQLA equals to 1 crore 20 lakh rupees and projected net outflow are 1 crore rupees, so LCR will become 120%. If HQLA falls to 80 lakh rupees, LCR declines to 80%, indicating a regulatory shortfall in this case. Let's move to another slide. So now we have the interaction of risks, whatever we discussed earlier. So these risks are interconnected rather than the isolated. Rising credit defaults can trigger the liquidity stress. Market shocks can erode the collateral values and strain funding. Operational failures can disrupt the payments and intensify the liquidity pressures, and liquidity shortage can force the asset fire sales, crystallizing the markets and credit losses. Effective risk management, therefore, requires an integrated, system-wide approach combining the capital, liquidity market and operational controls within unified stress testing and governance frameworks. So on this note, let's conclude the lecture. Risk is an unavoidable element of banking due to the fundamental role banks play in the financial intermediation and the maturity transformation. Credit, market, operational and liquidity risks, they arises from both internal decisions and external economic conditions. And each can materially affect a bank's profitability, capital strength and public confidence. Effective risk management requires not only accurate measurement through models, ratios and stress tests, but also discipline the mitigation using the limits, diversification, hedging, controls and capital buffers. Importantly, these risks are interconnected. Deteriorations in one area can quickly transmit the stress to another. A holistic and integrated approach supported by the strong governance, risk appetite framework and an ethical risk culture is therefore essential. When risks are identified early, assessed rigorously and managed proactively, banks are better positioned to withstand shocks, comply with the regulatory expectations and purpose sustainable growth while safeguarding the depositor interests and financial stability. So thank you students, that's all for now.